Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Hagren. Hey, Doug.
Good morning, Kirk. Happy to start another Monday with you. And what better way to kick off a week than being able to sit here and chit chat about everything and nothing all at the same time.
Yes, our listeners will thank you, Doug, for talking about nothing. No, it's good. It's definitely fall. I mean, I woke up the other day freezing. We didn't have the heat on, and I think it was down to like 34 in the evening. So it is officially fall. And we got Halloween coming up in about a week and a half, which will be fun. One of my kids is still interested in participating in Halloween. The other's not. He's in the tweener stage. You know, the younger stage, they're interested in Halloween, then they're not. And then when they get to college, they get into Halloween because they can walk around with pillowcases, fill it up for candy for the next 6 months, and they get to dress like I don't know, whatever they dress like these days. But anyway, it's a good time. We're enjoying it. We have 1, maybe 2 years left before they're not interested in Halloween at all. In which case, we'll just be the parents who still decorate the house for Halloween, even though our kids aren't interested.
Do you get people to come by? And you're in a pretty dense neighborhood, so do you get a lot of people to come by where you live?
Yeah, I mean, there's kids everywhere. I mean, we live near two schools, so there's kids everywhere. I mean, everyone wants to live there because they're near two schools. So, yeah, there's kids all over the place. It's fun. I mean, they don't really come to our house as much because there's some parts of the neighborhood. It's like when I lived in Beacon Hill years ago. That is probably the biggest destination trick or treat place in the state, maybe, um, because it's so densely populated. Everyone has candy. There's a lot of great, gifts that people give out, and there's actually, I think, 2 professional house decorators there. There's one of them that's always had like this crazy decorated house, and then there's another one who I believe is a special effects expert who works with Hollywood. So he's legit. And
Nice.
I mean, so these people really decorate their house to the nines, and it's pretty cool. Every year you see something different. And of course, they give out great gifts, and yeah, it's a good time. So,
Now, are you a big candy bar guy, or are you a little candy bar guy? Because
hey,
the
Doug,
older
don't
kids, we
talk
always
about the
like
size
to
of my
push.
candy bar.
Hey, so how big are your chocolate bars, Kirk? No, I
We
mean,
don't give
we
we don't
always
give out chocolate, Doug. We give out money. No, I'm
so
just
when I
kidding.
was growing up, we always liked to go to former Ohio Governor Rhodes' house, infamously known for being the governor during the Kent State shootings. But he lived in our suburb, and he was always the best place to go because it's more common now with Costco and places like that to find the full size candy bars. But back then it was we're talking like early 80s. It was a real mid 80s. It was a real treat, and he had every candy bar you could possibly think of outside his garage, on his driveway, on tables. You got to pick what you want. You could take as many as you want, and it was all full size, king size candy bars. So I mean, it was one of those things where you kind of hit your local neighborhood, got your bag of candy, and then took an extra trip to Governor Rhodes' house to double it with full size and king size bars. It was a great time. Oh, long since retired from politics, but always a politician. He was making sure that people were still coming by and knowing who he was up until the day he died. It was a treat.
Yeah, it's pretty cool when when you have this theme that you have and you just kind of stick with it. It's kind of like with our kids. And if you're listening in the car with little kids, earmuffs. Um, so when my kids were younger, when they kind of believed in Santa, um, there was a point where we didn't know whether they did or not, and they were just like, all right, do they believe? Do they not believe? And we didn't know, so we just kept playing it up, and we decided we're going to play it up for the rest of our lives. Even when they're like 40 years old, we're going to be like, oh, the Santa's coming. Like, it's just kind of become a thing. And I think it's fun, like when when you kind of create this new theme or habit in your lives, and you just kind of stick with it, even though you don't need to, right? Like, I mean, somebody like that's probably great when you're governor, but afterwards you don't need to, and you do it anyway. So it's just kind of cool. But anyway, it's we got one. Well, we got a week and a half until Halloween, and then you got 2 weeks until the election. So this will be this will be an interesting 2 week period. I did want to start the show um, with a chart or two, just because I think I don't like talking about politics. Well, I love talking about politics, just not in this show, because I think there's enough of that, and that's not why you're listening to the show. Um, but I did want to share this thing because I think it's really interesting. So this is the University of Michigan Consumer Expectations Index. Now, for those of you audio viewers, just tag along. I'll try to describe it. So basically, it shows the consumer expectations index. It shows the consumer expectations of Republicans, and it shows the expectations of Democrats. And what you're going to see here is what we call kind of an inverse correlation, where during the period of 2015 to or 16 to 20, you notice that Republicans had high expectations and the Democrats had low expectations. And then coincidentally, right after the election, it flipped, and it flipped to one where the Democrats had high expectations and the Republicans had low expectations. Now, does this mean that Trump or Biden are good or bad? No. What it shows is that your party has high expectation for their own party, which I find kind of amusing. Now, think about it, right? Is obvious you have high expectation for your party. Um, but at the end of the day, is that what's coloring your reality? And that's true, right? Our politics color our reality. If your party's in power, you think that what you're doing is correct. And I remember when the Democrats were the party, the bleeding hearts, and the party of peace and anti-war, and and now they've flipped, right? It's like it doesn't matter who, it just matters, it's like sports, right? Is your team winning? And that's kind of what politics has become. Is your team winning? So it's been an interesting election in that actually we've seen a lot of flips. There was actually a great skit with Jon Stewart, and he mocked the fact that there were a few Democrats switching to vote for Republicans, and then there were a few Republicans who flipped to vote Democrat. And one of the one of the famous ones was Dick Cheney, who says, "I'm voting for Kamala," and Jon Stewart says, "No, no, no, take him back. We don't want him." I mean, I have to give Jon Stewart credit. He is always hilarious, even though sometimes his politics are a little too much to take. I have to say, sometimes he just comes up with the funniest stuff. So anyway, so that's the first one I wanted to share, and the second one is, let's see here. Let's see if I can share it. It was interesting. Doug just sent it to me today. Oh, here it is. So the distribution of tech execs' political leanings inferred by campaign contributions. So it starts at the bottom and goes up. So every 4 years, you start to see a new trend by political leanings. In the 2000s, it was pretty heavily conservative. Um, and then you get into the aughts and then the tens. It started leaning more and more and more heavily Democrat. Now, I don't know why. I don't know what happened, but it's just the way it was. And then 2024, it's massively shifted to conservative right. So, I find all this stuff interesting. What does this infer? I don't know. You decide. It doesn't really matter because tech execs are a very, very, very small percentage of the population. However, it is interesting to note that the people who are effectively the new media of today, where they're tilting. Um, it's I haven't followed this closely for this election. I've just found this election fascinating, just in the way that people are moving around in their leanings. Um, but I will say that the old media was corporate media, right? You've got the cable stations, you got the news stations. Um, and that mattered who they were voting for because you knew, generally speaking, where their bias was. And bias affects us all. And I don't mean to impact one party over the other. I'm just saying that a bias impacts us all. We all have a bias. Unless you're not voting and you're not part of the system, you have a bias. And you might say, well, I'm independent. I don't have a bias. You do, because as soon as you vote for somebody, you're biased for that person because you want to win, right? We all want to win. And so when you start to see tech as the new media, which they are, right? Google controls SEO search. Meta controls what you see on their platform. X controls what you see on the platform. Microsoft through ChatGPT or Bing, who nobody uses, they control. Sorry, Microsoft.
I use it occasionally, Kirk, when somehow Bing hijacks my phone and becomes my default browser again without me selecting it. So, occasionally I'm forced into it by the powers that be to use it once, and then I flip back to the
You
other
got to
stuff.
watch those upgrades, Doug.
Yeah, exactly.
um, but my point is they are the new corporate media, right? And they're in control. And we know through images and things people have seen that they definitely have a left leaning, which is what it is. I mean, you got to accept it. But when you start to understand how they impact society, it's important. So I think it's always important to understand how the media of the day, the corporate media, tech media, impacts our thinking because it impacts us all. Um, and we might laugh when we see the pictures of the founding fathers happen to be no white males, but they're all women of color and different ethnicities who clearly weren't the founding fathers of our country. When you start to see stuff like that, it's like, all right, we've gotten a little bit off the beaten path of the way things should be. I'm not sure what the right way is. To be clear, I'm not sure if there is a right way. But I think accuracy is probably pretty important, and we don't see a lot of that these days with deepfakes, with all the stuff going on with Gavin Newsom's new law, which I will say for all the Republicans out there listening to this, I have a way to get rid of that law. It's quite simply Gavin Newsom spouts off BS all the time, as all politicians do. So you can use his law against him because he just impacted that law. He said, "Oh, you can't have anything that's clearly inaccurate about elections." Well, I'll bet he's doing it. All politicians do. So I see
How many of
stuff
them
like
were eating out and drinking at bars during COVID shutdowns? There you go.
the French Laundry. Yeah, I think I think actually quite a few, just not in California, but there were a few. There was it Boris Johnson in England? There was actually quite. I think Nancy Pelosi was as well. I think there were actually a bunch that were out in the middle of COVID. It wasn't just him. There were a lot of them. But
Yeah, I believe the governor, if I'm not mistaken, so don't quote me on if I'm mistaken on this, I apologize, but it might have been like the mayor of New York City or the governor of New York was there's a bunch of stuff that just came out about that too. At least one of the major, again, yeah, to prove the point, do as I say, don't do as I do, correct? Right?
Yeah, I think the problem today is not Republican or Democratic governors. The problem today is poor leadership. And I think that's pervasive in our society. It has nothing to do with parties. It has to do with our culture. Our culture is lacking leadership. When you see people like Jocko Willink, who everybody sees as like just epitomizes leadership and writes about leadership, and somebody like that, and you see people on podcasts when he gets interviewed. So you're going to run for president? We have a problem with leadership. People want Dwayne Johnson, The Rock, to become president. Like, he's an actor. What does he know about politics? A lot of people were asking him if he was going to run. Like, when you have that small of a pool to pick from that you're asking Hollywood celebrities, and rightfully so, they were right to turn it down because no one in their right mind would want this job. Um, you're getting shot at, you're getting stabbed in the back every single day. I would not want to be president, and nobody in their right mind should want to be there. Only sociopaths would really want to be president, and that's probably been true for quite some time. So anyway, moving on, because I want to get off the politics and onto other stuff. Let's talk about a chart crime. Doug, you want to talk about this chart crime I'm going to put up? And you know the one because you gave it to me. Here we go.
Sounds good. Yes. So, according to this, it looks like if you look at the head, the shoulder, and you look at where it's at right now, Bitcoin is crashing. Sell it all, get out. It's done. It's over. This is clearly an indicator that and how do I know that it's crashing? Because he drew a white line with an arrow on this chart telling me it's crashing. So we know that it is going from there to the bottom, get out now.
Yeah, and the funny thing about this chart is I will show you. Um, so just to be clear, you probably see these all the time. Now, what this is somebody inferring the future. Somebody here is predicting the future. Are they correct? Well, we only know in hindsight because we have the stock price for
They're
the
a
next
hundred
month.
percent maybe correct.
Sort of. Yeah, so this is what we call a technical setup. You have a head and shoulders setup, which alludes to the fact that if it's correct, it will break the neckline and it'll crash. And it'll crash approximately the same distance from the head to the neckline. That is a technical, that is the way that technicians look at the stock market, or in this case, the crypto market. And they're inferring if it breaks the neckline, all bets are off. Daisy bar the doors, like it's going to be ugly. And of course, that's not what happened. Here is what happened. Just to share this, let's see. Here is. Oh, come on.
While you're pulling that up, I want to
Yeah,
say
here
what's
it is.
funny about these situations is that they'll say if it breaks it, it's going to crash. But then they ignore the other times on the chart that it occasionally broke in order to create their line that shows that that line is now the new bottom. But that bottom's been met several times. It's so again, what's going to be, it's kind of like the jobs report, Kirk. Wait for the revision.
Yep. Yeah, it's so here we go. So here is the head and shoulders. Here's the shoulder, here's the head, here's the shoulder. And then right about here is where they marked it. They said if it goes down here, it's going to crash. Well, it hasn't. It hasn't technically broken a. Where's the head and shoulders? Oh yeah. So technically, once it breaks above the head, the setup is gone. So technically, it could be a head and shoulders, but probably not. That one's is most likely dead. Just for reference, for those of you who don't know, understand that. But I do want to point it out because we see these a lot. We see these charts where people are inferring the future. We don't know the future. Um, and if you don't know how to do technical analysis, you probably looked at that chart and said, "Holy crap, I should sell everything." Well, the reality is what that chart shows is it shows a setup. Now, a setup doesn't mean the future is going to happen. What it means is that if it breaks below the neckline, then it's going to go down. That's the setup. Now, it doesn't mean it's going to happen. Sometimes it could be a false breakout and all that. And there's a whole lot that goes to technical analysis more than just drawing a line, looking at the future, because we don't know the future. The point about technicians is they're looking at setups as ways to have a high probability bet on the future direction of an asset, in this case, Bitcoin. So that's the thing to take away from this. It's a chart crime. We see them all the time. If you go to technicians, everyone's talking about, oh my God, the world's going to end, or it's going to go to the moon, or whatever they're inferring, which to the charting community is nothing. It's just like, oh, this is pretty cool. Let me look at this thing. But sometimes you get a noob strolling in there who doesn't know how it works, and they're like, "Oh God, I gotta sell my Bitcoin. It's gonna crash." And what they really don't realize is it is it is technically a chart crime, but in the charting community, it's normal because it's showing that hey, if we do this, then this is going to happen. Unfortunately, if you're uninitiated and you don't understand charting, then you could probably lose a lot of money. So if you're going to get into charting, if you're one of those people that's just going to do that, I highly, highly, highly recommend take one of those online courses. They're free. They're all over the place, and learn about charting. Don't just run around with your money in your hand, just hoping to put money somewhere. Do some research, do the education, learn about it. And what you'll realize is um, that all the things you see are setups. They're not actually predictions. And they're showing a prediction. Now, what will typically happen if somebody's good at what they do is they'll show a series of potential setups. So this would be a series. This would be one series. Another one might be bouncing off here, going up, and then going down. That might be a second series. Another one might be going up. So you might see a series of things that happen. And it's better to look at the series and say, all right, here are the potential outcomes for what could happen. And that way you could say, all right, if these things happen, then it's in line. If not, then I should just ignore this completely and move on to something else. Unfortunately, we all get kind of tied into our thesis of being right. And so you look at this and immediately your mind flips to this is the way it's going to happen. When it doesn't, you're just like, that's not true. It's going to eventually happen. And then, of course, you make a bad decision. So I think it's really helpful to look at these once in a while, not for the sake of where it's going to go, but just as a chart crime to see what's happening here. This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone. And the prizes stink. But here's what you're going to win: higher prices at the store, shrinkflation in your packaged goods, higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today. So I want to talk a little bit about treasuries here for a minute, because the treasury market is actually changing quite a bit, and we don't talk about it, and we probably won't talk about it ever again because it's boring. But I do want to talk about the treasury market because for the last 2 years, since 2022, the treasury market flipped from being 0% interest rates all the way up to 5 to 5.5 on the short term on U.S. treasuries. And now the Fed has dropped their Fed funds rate 50 basis points, and they're talking about dropping another 50 after the election, which I think is a little bit aggressive. They're being a little aggressive here. I would say these aren't even microaggressions; these are macroaggressions here, Doug. To confiscate, to culturally appropriate language from the woke community. But anyway, so I want to show here. This is the number of treasuries owned. So 0 to 100. So they're owned by somebody. And if you look here, it shows different colors and Doug was probably going to tell me that wasn't showing it, and now I am. So you audio viewers can see it and hear it as well. All right. So U.S. Treasury ownership by different investor groups. So these are the different investor groups. There's things like the Federal Reserve, there's money market funds, there's foreign officials, there's banks, non-financial businesses, private foreign investors, insurance companies, state and local households, pension funds, and domestic financial other. So if you look here, you'll see trends that happen in certain areas. And what you'll notice is money market funds have picked up in the last year or two. What you'll notice, the Federal Reserve has kind of teetered off in the last few years. So have foreign officials, or the foreign official ownership, which we know a lot of countries like China and Russia are dumping treasuries, not in mass, but they're lowering their position size. Foreign ownership is I think it's about the same. But if you look at, there's no real noticeable increase, but there's a noticeable increase in a lot of areas. Banks, for sure, local and state governments. But I think the one thing to take away from here is just that it's owned by a wide selection of people and entities. Now, um, here's kind of the demand. As you see, households has picked up quite a bit since 2021. It's up 125%. Um, pension funds, insurers are up. Banks are down. Federal Reserve is down. Foreign is slightly down. Private is slightly up. Money market funds is slightly up. So if you see here, it's just really interesting to see the demand and who owns it. Now, this is the U.S. government debt and debt to GDP ratio. Debt to GDP is blue, and the black one is outstanding public debt. Obviously, outstanding public debt is going through the roof, as it always does. Debt to GDP is kind of gone a little bit sideways in the last 4 years. It spiked during COVID and then has kind of subsided a little bit and is starting to pick up again. So I just thought that was interesting. But what I want everyone to think about is this. U.S. Treasuries are a way that we fund our uh, our stupid spending habits as a government. When we have a deficit on our budget, it means that we have to borrow more money to fill the hole, right? If we pull in a trillion dollars and we're spending 1.2 trillion, it means we have a $200 billion deficit. And that's frequently what happens, and the deficit keeps getting bigger and bigger, and our budget keeps increasing, even though the taxes are not covering it. So our deficit keeps growing, and growing at a more rapid rate, I should add, which is a problem. Because if you look out and you look at our recency bias, say, oh, it keeps going up. Recency bias says, well, it's going to go on like that forever. Now, knowing our government, that certainly might be true. We may just keep going higher until something blows up. And my guess is that's what's going to happen because no one is holding these politicians accountable. Now, I want to be clear about something. I want to be clear, right? If you haven't, you probably know which politician I'm talking about. I use that all the time. I want to be clear. So let's talk about it this way. Our politicians do things because they can. They supposedly represent us, but they don't. Very few of them do. However, here's what they do. They do whatever they want to do. And the only way that we can hold them accountable is by voting them out. That's all we can do as citizens. If we decide someone is not, doing the people's work, you can vote them out, and you should, right? Because they're supposed to represent us. And when they don't, you should get rid of them. Yet in this country, most people don't because we're partisan. We'd vote. Either party would vote in Hitler if they were head of their party because they have their partisan name on it, which is unfortunate. We used to think as a country and have more thoughtful discussions, and now everybody's just extremist in their views. And we're not really having thoughtful discussions, unfortunately. But hopefully we can get back to the point where we can have very thoughtful discussions about our budget, because at this point, the way it's going, we're eventually going to be bankrupt probably in the next 5 to 10 years, which would be very unfortunate because I don't think people realize the pain that's going to cause with the high inflation that's going to ensue because of that. And there will be high inflation once we get to that point. Mark my words, we will. And it'll be very painful for everyone. So I want you to understand about treasuries is that if we have a debt, right, or a deficit, we have to fund that with treasuries or debt. And treasuries have to be sold to the public, and the public has to buy it. So if you're giving away a 0% treasury, no one's going to want that, right? If you're giving away 5% treasury, well, crap, a lot of people are going to want that. We did. I wanted it. I bought it. Our clients owned it. A lot of people owned it, right? Because you're getting 5.5%. Not anymore. Right now you're getting about 4.6, I think, percent. I have to look at it today, but I think last week was 4.6% in treasuries, which is still not bad. It's not as good as 5.5, but it's still okay.
I want to interject there. If you
Yeah.
look at the historic 60-40 portfolio, which we're not saying is the way to go, how did they do the calculation? It was around a 4% return average on bonds that they were expecting. For a long time, it wasn't hitting that. So, yeah, if you're achieving 4% on short term, you're still doing pretty good historically.
Yeah, I mean 4% is still decent, right? And I wouldn't, I wouldn't bat an eye at that. I mean that's a good return. Now I would prefer 5 and up personally, but 4.6 is still decent on the short term, and it's probably going to keep going down. The trend is down. When the Federal Reserve makes a move, the trend is the direction. You should plan on the fact that they're going to continue in that direction for quite some time. Um, they don't typically, and certainly for a 50 basis point move, you're definitely going in that direction. Um, sometimes they might do it in pause, but directionally, they're not going up and down. That's not their way. They would rather do nothing and see a trend than to go back and forth. So just be aware. That's how they typically operate. But we're going to have to keep funding this debt, and we're going to have to keep having people buy it. So the Federal Reserve can buy it, the government could buy it, banks could buy it. The Federal Reserve and our government can incentivize banks to buy it, as they did for decades, in the tens and up until pretty much 22. The banks were buying a lot of it, and some banks, you could argue, were insolvent, as a few people certainly have espoused that certain banks, one of which is quite large, and so I won't mention the name, is insolvent because they have an upside down bond portfolio, and if people start pulling their cash, they're gonna be insolvent. So I'm not going to mention the name because I don't want to start a bank run. But the point is that the bond market's very important, and if no one's buying U.S. Treasuries, then we have a real problem, right? So foreign buyers have been shrinking the size of their Treasury portfolio over time. They've been letting it run off. The smart move for them is letting it run off and not rebuying. So China's doing this, Russia's doing this, a few other countries doing this, where they're letting their portfolios, basically dwindle down. So, $1 billion came due, great, give me that cash. I'm not going to reinvest it. And so we need to find new buyers. If we don't find new buyers, what happens is the price drops. If the price drops, it means the yield goes up. Now, here's the thing, and this is why I'm mentioning treasuries. If you want to know when our country's in trouble, watch the bond market. Because if U.S. Treasury yields start spiking higher, it means that there's no buyers. Because people aren't willing to pay the price, which means that the price goes down. The price goes down, the yield goes up. So if yields start spiking higher, it means no one's buying. Now, I will say our government and Federal Reserve are, in my opinion, very manipulative. And I don't know if they're corrupt, but they're certainly manipulative in the sense that they would buy it. And they would find a way to buy it or just shove it into banks' balance sheets to force them to buy it. So the whole financial system's kind of rigged around this to protect us from foreign countries dumping treasuries. But you should be aware that if that starts to happen, it's a problem. And it's the same problem when you look at like hyperinflation. The problem isn't that we have high inflation. The problem is that people stop trusting the currency. So when you see the velocity of money spike, that's a problem. So for all those of you looking to see when the world's going to end, the velocity of money spiking and people aren't buying U.S. treasuries. That's a problem for our country, for our currency. And when that happens, you better be very prepared for what happens next, because that's a bad sign, right? Venezuela is going through that. If you look through, Zimbabwe went through this. It's ugly. So
Argentina lived through that for decades.
Yeah, it's like the way of life down there for Argentina. The people down there are so good at managing it that they don't even care anymore because they know how to handle it. Most of them just go to the country next door and they just go do their banking over there. I mean, it's been a way of life down there, and I think if you are accustomed to it, like people in Cuba who don't have any power and haven't for quite some time now, because their aging power plant went down. You get a country like that, people are used to living on nothing. I mean, I've been to Cuba. It's people are dirt poor. Like you think people in this country or other countries are poor? No, these people have literally like grass huts. There's some really, it's pretty bad in some of those situations. So not everybody, but definitely there's some people there who are. And communism doesn't work. If you want to know communism doesn't work, go to Cuba. It's a perfect example of communism in action. It doesn't work. It just means everyone has less. It doesn't mean that there's no rich. It just means everyone's poor, except for the people in power. So it obviously doesn't work. There's been no example in history of communism working. So those of you who think it does, you're kidding yourselves. It doesn't work anywhere. Anyway, Doug, where do you want to start here for charts? I just went over treasuries, but I want people to understand that mental model, because if you understand that, you'll know what to look for.
Well, recognizing that it's going to be hard for you to find the chart, so because we put somebody in there, you did post an interesting chart since we talked about kind of bringing things around, full circle. We talked about that chart crime with Bitcoin, and you had actually posted something around the correlations between Bitcoin and liquidity,
Mm,
which I think was really interesting to see, because he just talked about we start to see yields go up, but we start to see the momentum of money. M2 money is interesting. So Bitcoin has been on a little bit of a run recently. Ironically, it's about the same time as the stock market has been on a run recently, about the same time that M2 money has gone up again recently. So again, there's a lot of people that are, gold bulls and anti-Bitcoin, and then they got these two crashing at each other, and the Bitcoin people are sitting there saying, look, Bitcoin to 350,000 by the end of the year again, which is just, just cracks me up. But yeah, but what they tend to forget is the correlations and when these things have happened before. If M2 money supply is going up again, guess what? That money out there, people are using it to look at, investing in things like Bitcoin, and gold is rising significantly, which has typically been a place where people have looked as a shelter against inflation. Bitcoin doesn't have the longevity and history to tell you what it's going to do through any kind of market cycle yet. We haven't gone through any type of recession or crash since Bitcoin's been, prominent. So, we need to see those types of histories to know how people are going to react. But if one thing that tends to happen is that correlations tend to work really well in up markets, but they tend to work very poorly in down markets. And what that means is typically a correlate, if you have reverse correlated or negatively correlated or uncorrelated assets, meaning they tend to overperform during times in which, when things are, when they're, they tend to overperform together, or if they're correlated, and negatively perform together when they're correlated versus uncorrelated. There's no pattern, and negative correlated means that when something overperforms, a negatively correlated is going to be more tending to underperform. And that's kind of why people have looked at bonds versus equities historically. But what they found is that the correlations during good times, up markets, have tended to work better than correlations during down markets. So what that means is that diversified portfolio of yours is doing a great job of correlation against your performance when times are good. So hey, it's like, hey, I've got 50% of my portfolio to bonds. Those bonds are dragging down the performance of the portfolio against the performance of equities, which consumers struggle with because they say, well, the S&P 500, did 15% this year. Why didn't I get that? Well, because 50% of your portfolio was in negatively or uncorrelated assets, which would have tempered down the performance. What they've also found is that during times of negative performance, when things are at their worst, correlations stop working. In other words, what happens is that people get panicked, and they instead of these things working where they're supposed to, they sell everything. So why am I saying that? Because yes, people are buying gold right now. But guess what? We don't have really a system in which people can just chisel off some gold and hand it out, right? We have a system that's driven on currency. Bitcoin, again, hodlers, they want to sit on Bitcoin forever. The issue that we don't know about yet is that when things get tight and the consumer and the average American, and we've shown lots of data about the pressure that's really happening and building on, the lowest income classes of America, that's driving up into the into the middle class, and even to the, beginning to reach up into the bottom of the upper class. They're starting to get strained. And some assets are more liquid than others. So now what happens? All of a sudden, you have the stock market's going up that you can sell, you can use those assets. It's kind of fairly liquid. You can easily get to it. Well, markets go down. You don't want to sell that, right? Nobody wants to touch things when they're down. So guess what? They're still going to need that liquidity. If jobs are if job losses increase, other things happen in a recession that make cash flow. And you talked about inflation. So you got the double impact of cash flow gets tight, but everything's gotten more expensive. I've got a chart in there that shows, where, inflation is going down, but core inflation is still extremely high, which means that everything we need to buy, exceptionally expensive. My utilities are 2 to 3 times what they were a couple years ago. And that's, I can't just turn off the, my utilities in my house. I'm forced to buy it. I still need to eat. So those things have gotten more and more and more expensive. You talked about this, I think, last week. One of the reasons real estate is popular is that if you have a payment on real estate, that price doesn't change. That is, I would say, not even inflation proof. It's inflation negatively correlated to inflation, because technically, as everything else gets more expensive, the payment on a mortgage or any type of installment loan feels like it's getting less, and it does become less and less as part of your overall budget. So what happens when people are tight, when they don't have the same income coming in, but they've got rising expenses? They have to liquidate somewhere. Again, we don't have a system readily available to do transactions other than typical fiat currency. It's changing. But what we don't know until we get into recession is what is going to happen when people get pressed. What are they going to have to sell to create liquidity? And that's why it's going to be really important with all these predictions out there to see what really happens when people get strained, because that's when, it becomes a lot harder to hodl when you are, and we talked, hold on for dear life. That's what it stands for. It becomes a lot harder to hodl when you have less options on where you're going to get your money. Right now, there's still a ton of liquidity out there in the system, which makes it easy to take surplus and put it somewhere. But we are seeing, and again, if the charts are all over the place here, Kirk, because I'm just going to speak to it, but consumers are fairly pessimistic about the future. Okay. American expectations of financial situation in the next 5 years dropped to the lowest in 11 years. Household expectations have fallen in a near straight line as inflation has persisted. I've got some charts up here to kind of show that impact of inflation. If you had $1 million, okay, and this was back in 2024, it had the same buying power as $500,000 as did in 1996. So for those of you out there who were working at that time, so you'd be a little bit older now, you're feeling half the value of your money that you used to. Okay, it's buying half of what it could, and unfortunately, with inflation spiking the way it did, it's creating a scenario in which that could, as Kirk just talked about, exacerbate at a higher rate over the next couple of years. Now, granted, inflation has come back down in general, but what does inflation back down mean? It means we didn't give up what those price increases. We just slowed down the rate in which they're increasing now. But core inflation, unfortunately, is still extremely high. Home insurance, auto insurance, food, housing, all of that stuff is still extremely high. Now, let's take a look at that number again and go from the $1 million in today feeling like 500,000 1996. The biggest issue is that the last 4 years, your income would have had to increase by 23% to keep up with just the inflation of the last couple of years. So $100,000 income in 2020 has now, and this is using the government's data, so it's a really good point from Geiger Capital that, hey, it's probably more like a greater number because, again, the government is looking at CPI. The real issue is core inflation and what's actually forced to be paid for. But if you had $100,000 in 2020, you need $122,000 today, according to the government, to feel the same. So that means essentially, if you're making $100,000, it's buying the same as about $70,000 4 years ago. That's extremely difficult for many families to be able to overcome because they can't just magically wave a wand and see that income, increase. Now, what's helping, and this is why you talked about this a second ago, Kirk, is that what is helping is that the Fed is doing things, right? So we don't want to name any names here, but the Fed does things to make these entities still solvent. The stock market is still strong. As long as the stock market is still strong, people feel comfortable. There's something called the Buffett indicator. Okay, the Buffett indicator just blew past 200. So what does the Buffett indicator mean? The Buffett indicator is an indicator that shows the ratio of the US stock market divided by GDP. Okay. So in other words, the stock market is super high compared to the GDP that we can produce. That means that again, we could be a sign. It is one indicator of an extremely stretched. You also talked about the treasuries. This is something that's really important to understand is what is there are times in which it makes makes a great timing to go into certain types of bonds, and one of those is junk bonds. I've argued for many years when I've talked to my clients and people out there that I believe a junk bond is almost like a high dividend, extremely accelerated stock. Okay, because junk bonds tend to do extreme volatility. They obviously, if you think about it, when we talked about 4% yields, 4.5% yields of short-term treasuries, people consider that to be a risk-free rate. It's like, hey, government's not going to default. Cross your fingers, right? But they control that money. The money that you get on it, you think about if I hold it, pretty confident I'm going to get all that money back at the end. Well, think of credit cards, right? If you have a poor credit rating and you want to try to get a new credit card, if you can get one, it's going to be a high interest rate. That is going to pay the lender for the risk that you are. Okay. Junk bond yields are kind of work the same way. When a company or a municipality or whoever or government entity is trying to borrow, they're going to have to charge more money or be charged more money if they have a poor credit rating. So junk bonds are effectively companies and entities that have a poor history of financial solvency. Well, the problem is then we saw this right before 2008, is that junk bonds should have a really high interest rate. Again, you should be charging a lot. But as you get to a point where you're not charging enough for that risk, you start to create a very risky situation of not getting paid enough for the risks that are out there. Now, junk bond yields currently have the narrowest spread compared to the Fed fund rate in 34 years. It's the lowest level since 2007, just before the peak of the housing bubble. Okay. Again, no prediction of where that's going to go. But again, if that spread is again, I know we don't like to talk about fixed income and bonds too much, but since we're on it, this is a really important thing to note because that spread should be much, much, much higher. Okay. We should, and unfortunately, they've narrowed to the point where, again, the risk payment isn't there for the risk that's being taken on the junk bonds. I like to look at junk bonds kind of in a way where, when the economy is back at that last cycle, it's probably a place you don't want to spend, you have a ton of your money in. Why? Again, the risk, the volatility. If these companies were struggling when times were good and times get harder, there's a greater risk of default out there. And therefore, it's going to be a much larger impact of volatility on those as their economic situation gets more dire. Now, contrary, let's talk about coming out of a recession, and now you're in an expanding economy. Those companies that struggle, that have the worst financial circumstances, again, those that would be those that are issued junk debt, have made it this far. There's a really increasingly good chance that as the economy improves, they're going to survive because things got easier. So where does that become an investment opportunity? Well, they're going to have, hopefully, a much higher interest rate that they're paid and a decreasing amount of risk that they're going to default every day the economy improves. That, again, could be something that has a better allocation and ultimately get paid for that risk as things improve. But right now, we know this economy, we don't know where it's going to go. Heck, we've been predicting, some people have been predicting, well, as you know, Kirk, some people predict a recession about every 5 minutes. But those that look at the economy and look at the metrics said, there's risks here of recession that have been happening now for a couple of years. It hasn't happened. Who knows if it will? There's new predictions every day. But that strain and that narrowing is certainly something that needs to be noted because that does tend to be something you see as things are continuing to decline and people are stretching more and more for more yield in their portfolios. The last thing, again, talking about that impact to the consumer, we're starting to see delinquencies on U.S. auto loans are skyrocketing. Auto loan 90-plus day delinquency rates are now 2.88%. That's the highest since 2010, and it's almost doubled in 2.5 years. It's not a surprise to me because obviously a lot of those people probably took out these loans, got these cars when the auto prices were through the roof the last couple of years. Said, you know what, I need a car. I'm just going to take it for whatever I get. Interest rates on cars, especially for, even at great credit ratings. I mean, some people, I've heard stories out there with, 750 plus credit ratings were getting auto loan offers at what point in the 15% range. That has come back, but if they took those out, that's an extreme stressor to an already pushed cash flow. So, here's just some things. I kind of looked through the counter of some things there that are obviously, flags to be noted. But at the same time, as we've seen for many, many years in this economy, there's also a lot of positives, that are out there right now that are giving enough reason to think, hey, look, is a recession imminent? No, because we have a lot of conflicting data. The share of unprofitable Russell 2000 companies is now at 43%. Most of these small cap companies are also saying they feel now is the worst time for the expansion. Again, what does that mean? Well, if the majority of companies in America are small companies, that is a fact. If you add all that up, that is an impact on hiring. So again, if they don't going to expand, they're probably not going to hire. Those things, tend to be things to watch. 512 large U.S. companies have declared bankruptcy year to date. That's only 6 less than 2020's pandemic. So that's the largest bankruptcies. Whoops, bump the mic, in 14 years. So again, everybody's a little bit more strained. The costs are absolutely higher for everybody out there, especially if we look at, the core cost of inflation. So, Kirk, back to you. I'm just going to take it, let you kind of finish us out here.
All right. So I wanted to touch on one or two things, and then we're gonna wrap it up in the interest of time. So first, I want to mention, because I was actually just down there, and now I can't find it. There it is. All right. So I want to share this because we actually had a guest on talking about short-term rentals, Airbnb kind of rentals. And I was actually just down in Nashville. My kid was playing in a hockey tournament, and I was down there, so I have a good sense of what was going on. But what this is talking about is hotel tax revenue. And it just shows that basically in August, it just went through the floor. It's been declining since COVID's recovery. But now it's actually in the negative. And so it's just like a WTF moment. Now, I only point this out. Airbnb collects tax in Tennessee, so this includes that. I actually, when I was there, I couldn't find a hotel room because we had to switch because the hotel we were in had mold everywhere. Like, it was in the air, it was everywhere. I mean, it was bad. And it was a brand, so I'm not going to name it, but it was really bad. We had to actually find a new hotel. We couldn't find it. Now, granted, it was probably a busy weekend, but we had to go like 20 minutes outside of Nashville to find a place. So I'm not sure what that's due to, where that drop is, as we see here, but I will say that in general, the trend that people have been seeing in the short-term rental market, the Airbnb types, VRBOs, that there definitely has been a decline in demand. We had a spike after COVID. Has been slowly declining. Fewer and fewer people want to do it. Frankly, it's always a question of whether you do short-term rental or a hotel. Personally, hotels are easier because you know what you're going to get. Short-term rental with Airbnb or what have you. The guy we just had on actually was a really interesting interview. So if you guys if it hasn't come out already, it's interesting. I found out a lot of things about that market I didn't know before. But some of the comments that the individual was making was basically about you have to be a really good renter in the Airbnb market and come up with some unique experiences as opposed to just having a warm bed, just actually make it a little bit unique. So I thought that was interesting. But we are seeing the trends changing in that market as well, which if you're in that market, you want to be careful. Um, so we're going to wrap it up here in the interest of time. I know it's we're on the hour. Uh, I do want to mention one thing, as Doug was talking about correlations in bull and bear markets. I did want to clarify something because we did some research back in the early 2000s on this. And to be clear on the correlations, in a bull market, correlations are normal. So Doug explained it very succinctly, but I'm just going to say they're normal, like what you would expect to be normal in a bull market. In a bear market, they all correlate, meaning everything goes down together. And that's not normal. Or sometimes they do weird stuff. But generally, with a crash, everybody just gets out. They don't care what they're selling, and everything correlates. That's the problem with diversification. It doesn't work in bear markets when you need it most. And that was the conclusion we came to with our research paper, was basically in normal times correlation works, and in bad times it doesn't work. So why are you diversifying? Because it doesn't do the job you signed up for it to do. Anyway, Doug, where can people find more about you?
Well, Kirk, appreciate it. Listen, costs are going up everywhere for everybody on everything and core inflation. And Elon Musk came out the other day and there was a speech that's been kind of hitting the social media airways about is college a waste of money. And we're starting to see more about that coming out, and there's definitely evidence that for many people it might be a waste of money, or at least traditional 4 years of college, but because the trades, there's definitely huge demand there. It's a lot of work. It's hard it's hard on the body, but you can make a lot of money there, and potentially a lot more money, at least in the early years, than you can just trying to come out of a 4-year education. That being said, there's a lot of degrees that, that are critical for certain careers, and families still feel it's an extremely important thing. So many of you listening are probably worried about college costs because you feel this is a core necessity. You want to take care of kids. You want them to go to college. You're not alone. Many parents face this challenge. You want to support your child's education. You don't want to jeopardize their financial future. And the rising costs of college can be daunting. So if you have the right plan, you can actually navigate these challenges and achieve a state of mind. We have a personalized financial planning solution and a free report you can download right now to get an idea of those costs so that you can actually begin to plan smartly for how you're going to approach the cost of education, which can be as much as a house can cost you in only 4 years. Check out our website, mergentcollegeadvisors.com. That's MERGENT, mergentcollegeadvisors.com. And get that information today. Download that free report. And if you have any questions, let us know.
Great. Well, Doug, once again, thanks for coming on the show. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.